My name is Sheila Vertino, and I'll be your host for today's session. Our main goal for the Solution Series is to provide you in a 20-minute time slot with some fresh insights and practical tactics, positive strategies to help you succeed in today's tough business environment. To do that, we need to choose topics to make the Solution Series extremely relevant and responsive, and we need your help. We encourage you to help drive the content, give us suggestions in the follow-up surveys that you'll receive, or just send us an email. Let us know what topics and presenters you would like to hear from in future programs. And if we can go to the next slide now. I'd like to thank the Harvard Business School Real Estate Program, Real Estate Executive Education Programs for sponsoring today's program, designed to help seasoned and emerging leaders protect their assets and manage complex projects. These Harvard programs also help participants to navigate global markets and capitalize on new opportunities. For more information, you can visit the Harvard website at www.exed.hbs.edu. And Shane, can you click forward to the next slide, please? Just say a few words about the upcoming webinar. For those of you who have participated in the Solution Series before, you know that these are meant to be quick bursts of information, but there are some topics that require a more in-depth treatment. And for those, NAIOP offers 90-minute full webinars. As you can see on your screen, the next full webinar will take place on Thursday, February 25th, and Susan Bryson with Wigan and Dana will lead a panel discussion on how an entity qualifies as a community development entity. Basically, she's going to discuss the application process and the do's and don'ts about that process. We have reduced the cost of the webinars, and they are now $65 for NAIOP members and $95 for non-members. To register for this full 90-minute webinar, you just go online to naiop.org/thecenter, THECENTER, and that's a brand new area of the NAIOP website with all of our educational offerings in there. And then, Sean, if you can click one more time. Thank you. We'll be able to get on with our Solution Series program today. And today with us is Shane Baldwin. Shane is CEO and president of SilverLeaf Financial, and they're a private equity firm headquartered in Salt Lake City, Utah. And it's Shane's ambition and determination and self-belief that have propelled him into becoming the driving force behind SilverLeaf Financial. To date, the company has acquired nearly 50 commercial notes and 321 residential mortgages, totaling approximately $200 million in face value notes. Also joining us is Deanna Polizzo. She is Vice President at NorthMarq Capital. Deanna is responsible for expanding the origination of debt and equity for commercial properties in the tri-state New York, Connecticut, New Jersey area. For today's Solution Series program, we've asked Shane to kick it off with a presentation about his business model for SilverLeaf Financial. And then Deanna will join the conversation with some questions for Shane about unlocking the huge liquidity logjam. So welcome, Shane and Deanna, and thanks for being with us today. I'll turn it over to you, Shane.
Great, thank you. Appreciate the introduction. As was mentioned, SilverLeaf is a private equity firm that focuses on buying whole loans. Our focus is typically looking at loans that are commercial in nature, where the underlying collateral has cash flow, so that in the event we have to take the property back, we have a property that has cash flow. To give you a little background of how we came onto the market, in March of 2008, we saw several opportunities that would be coming our way because of the failures in the different financial institutions and banking institutions. The first bank that we really noticed failed in March of 2008, and at that point we decided that our focus was going to be buying these credits from these banks that have been taken over by the federal government. When we first started, we started by organizing people that we felt like could add different components to our overall business plan. We've brought in people that have been in real estate for 30-plus years. One of the partners was a former partner at Arthur Andersen, and he was on the audit side, and he did several bank audits, and so he understands the banking landscape and environment. We also have an in-house attorney, a mortgage and actually loan servicing division, and basic collection company. The reason we look to acquire first position debt secured by income-producing commercial real estate was, as I mentioned, in the event that we have to take back the property, we wanted an asset that had cash flow. And we looked at, from an investment point of view, if we buy a loan and the borrower isn't cooperative and we do have to foreclose, ultimately the only properties that are getting any financing in today's market are properties that do have cash flow. However, our goal has never been to actually own the real estate. Our goal has always been to buy loans secured by commercial properties, but we heavily underwrite the borrowers of these loans. We typically look for borrowers that have businesses that are non-correlated to real estate. Now, what do I mean by that? When we look at borrowers, we're looking for borrowers who are not developers, who are not real estate professionals, but rather borrowers who have different businesses, borrowers who are maybe doctors and are just investors in real estate. We've also come across a second component to our business, which is mentioned here on the structured sale platform. The FDIC has become smarter in that they want to participate in the upside of the loans that they sell. One of the things that we have focused on in these structured sales is being more of an asset manager and not necessarily buying the whole loan. These structures are a partnership or joint venture with the FDIC. The FDIC has done 10 of these types of transactions where they partner with the private equity community and share in the upside of the workout of those loans. We've also developed strategic partnerships with other private equity firms. I mean, one of the challenges, and should be noted for the people on the call, we're a relatively new firm. We've been around for 18 months. One of the challenges was always, we have a business plan, we understand what it is we want to do, but ultimately you need to be able to raise the capital to buy the loans. When we first went out to raise money, we hadn't done any deals. And it wasn't until we had done several deals that we started attracting capital. So we partnered with other private equity firms, large hedge funds, institutional type investors, and real estate organizations across the country to help us evaluate and understand the real estate in the different markets. We own loans from Florida to Boston to Oklahoma to Arizona to California, and each one of those markets is different and very unique. And so we've partnered with other real estate organizations to help us evaluate and manage the properties and loans that we purchase. When you get into this space, and a lot of people we have seen have started looking at buying loans instead of buying the actual REO, the key is maintaining a constant and steady flow of product to purchase. The FDIC is a great seller. Loan sale advisors are hired by the FDIC to actually sell these loans. The other seller of loans in the marketplace right now besides the FDIC are banks, and we're seeing a surge of special servicers that are also selling what is formerly known as commercial mortgage-backed securities. These are loans that were securitized when that market existed, and now they're combining the tranches back together and selling the whole loan. You'll see special servicers selling loans like CW Capital, Centerline, J.E. Roberts are some of the sellers of loans. The good and bad about buying CMBS is typically those loans are all non-recourse, so the borrowers are not guaranteed on these loans. But what you do find from special servicers is the origination of these loans are far more sophisticated, as are the borrowers. We have a staff that focuses on underwriting and looking at different loans. They perform, as it says in the slide, extensive loan file and market data research. I just recently were looking at a deal in Texas, and I was out there with one of our underwriters actually looking at the property, walking the property, because we have to underwrite every loan as though we're going to end up owning it. Our goal, like I said earlier, is to buy a loan. This is a good example. This is a loan that was originated in 2003. It's a 148,000 square foot retail property in Texas. The borrowers originally borrowed $4.5 million. They paid it down to $3.5 million. They are not in monetary default, however, they are in technical default in that their reserves are too low, and so the lender can foreclose if they would like, even though the borrower is making payments. The borrower has come out of pocket in the last 6 months and spent $650,000 to renovate a space that was vacated by Sam's Club. They've subsequently released that space, and we believe we can purchase that loan at around $1.1 million, $1.2 million. The face again is 3.5. So as we perform our research, we're looking at the borrowers. In this instance, the borrowers have a considerable amount of equity in the property. They paid it down by $1 million, and they're making their payments. So we believe they want to keep their property. So our goal in that instance, after purchasing the loans at these discounted values, would be to go back and offer the borrower some type of discounted payoff. He owes 3.5. We would see if he would be interested in buying his loan or refinancing his loan at 2.5 or $2 million if we were able to buy it at 1.1, 1.2. So that's kind of start to finish how deals work. We've purchased, as was mentioned earlier, about 48 of these types of transactions across the country. Our goal through 2010 is to purchase an additional $200 million of distressed whole loans. We're seeing on the market right now, there is in the first quarter about $800 million worth of product on the market for sale, whole loans, commercial in nature. We recently bid on an FDIC structured transaction. The winning bidder of that was Lennar, a home builder. Our bid on that particular offering, it was $541 million worth of commercial construction loans from the FDIC. Our bid was 30 cents on the dollar. The winning bid was 41 cents on the dollar. There was a press release that was done on this purchase by Lennar, and we actually were third in the bidding. So our goal is to do one of those structured deals and partner with the FDIC in one of these portfolios. Many of you with NAIOP may or may not have loans with banks that have been taken over by the FDIC. More than likely, if you do have loans that have been with banks that have been taken over by the FDIC, they will more than likely be put into one of these pools and sold off in one of these structured sales. The key when you're buying loans, in my opinion, is twofold. Really understand the collateral and what the underlying collateral is worth. And number two, understand your borrower and who your borrower is. Is your borrower somebody who not only has this loan but several other real estate loans and is likely to file bankruptcy? Or is your borrower a rheumatologist in Las Vegas that's been practicing for 16 years and has cash flow from other businesses other than real estate? Once you can really understand the collateral and the borrower, then you can decide exactly what it is you're willing to pay for any particular note. For some of you that may be real estate agents, one of the things that we're finding is real estate agents are starting to get into the mix in that they're working with banks and actually brokering notes. And we're getting calls from agents across the country that are looking to sell us notes. The second thing is sourcing investor capital. As I mentioned earlier, it's one of the most difficult things to do without a track record. Oftentimes you have to do several deals in order to attract investor capital. And that is an interesting challenge in and of itself. And then the third component is you're going to end up owning some of the loans that you're going to end up owning the real estate. And so it's having a team equipped or a third-party manager equipped with managing your real estate owned and understanding how to optimize the overall value of that asset once you take that asset back. What we see in the market is a tremendous amount of loans that will be sold to the private sector over the next 3 to 5 years. In several studies, it's been shown that there's $1.2 trillion worth of commercial mortgage-backed security loans that will come due over the next 5 years. The question is, where are these people going to find the financing to refinance their loans out? And with the default rates being where they're at, how are these special servicers going to deal with all of their defaulted loans? So we see an increase in overall loans being offered to the market and overall loan sales.
Well, that's a great overview of a very aggressive business model, Shane. Deanna, would you like to jump in now and pose some questions?
Sure. Shane, let's start first with the big question that everybody always has in terms of sources of capital. I know that you had said before that you get some of your capital from hedge funds and a variety of private equity firms and different groups, and that raising that capital has been the biggest challenge. In terms of the sources of capital that you have been able to raise, have you found that it's coming from any particular market segment in terms of REITs or things like that? And are these firms that would normally be investing on their own, and because they aren't finding product, they're investing through you?
Yeah, one of the groups that we deal with is a private equity firm out of Kuwait. They were heavy into real estate. They've been in real estate for 30 years. The biggest difference for them is they don't understand how to buy debt and how to analyze the debt. And so normally they would just go out and buy REO. But with the pricing that we're getting on certain assets, we're able to, if we want to get to the real estate, we can get to the real estate at a much deeper discount than if we went out and bought the REO. So these other funds, real estate funds, are interested in our ability to analyze debt, understand the debt, and invest and partner through us. We also have a pretty big segment of, individual private net worth investors that are investors with us as well.
Now, are you finding that most of these firms are discretionary, meaning that are they just allowing you to make the decisions, or do you have to go back to them in order to get their approval when you decide that you found something that you want to buy?
Well, the more institutional players are actively involved with us in deciding which deals. One of the things that we found early on is we originally intended in raising just a fund, a traditional kind of blind pool fund. When we went out and explained the concept to these individuals, they thought it was a nice concept, but what we're finding is more and more people are more leery of investing in blind pool funds. They want to know the deal that they're invested in, and they want to decide whether or not they're going to get into that particular deal. So the challenge with these types of transactions are you make a bid. If you are awarded the bid, you put up typically 10% that's hard, and your closing is very quick, 10 to 14 days. And when we first started, we would put up the 10% that was our own capital of risk capital, and then I would scramble to go and find the other, call them limited partners or partners to participate in the acquisition of that particular loan. And to date, that's how we do all of our transactions. We have groups that have committed capital to us, and when we win a bid, I get on the phone with those different groups and explain the deal to them, why we like the deal, what our thesis is, what our exits are, and then they decide if they want to participate and to how much. With the individual guys, we do have a lot more discretion. With your larger hedge fund and institutional type players, they want a little bit more control.
Okay. Let's talk a little bit about the types of loans that you're acquiring, because one of the things that we hear an awful lot about is, balance sheets being frozen, and there's all of these assets out there. And I know personally I talk to a lot of folks that are looking to get their hands on some of this collateral, and they've had difficulty doing so. How do you identify the loans that you're going to buy and which markets you want to go into or which ones you don't? Because I know that one of the things that you had mentioned was that you sometimes will buy pools and other times you'll buy individual assets. So are there any markets you won't touch, and are there any that you prefer?
Well, after buying 321 residential loans, I think I've had my fair share of residential, and I probably won't touch residential again. It's a lot of work. There's a lot of emotions involved when you buy a residential mortgage and it's somebody's personal residence as opposed to a commercial asset. So we're really not interested in buying large residential mortgage first position trustee pools anymore. It was a good experience, and it will be profitable, but it's a tremendous amount of work. When you talk about the commercial market, you know what, quite frankly, there's not a market I don't think we haven't been in yet. We have one asset in Michigan. We have assets in Ohio. We have assets in Indiana. We have assets in Florida, Arizona, California, Las Vegas. I mean, these are very, very tough markets. But in the same respect, we're able to get fantastic pricing in those markets. I bought an $8.9 million loan in Bowling Green, Ohio, which I paid 27 cents on the dollar at. I paid $2.3 million, and the asset is a retail complex that has $420,000 of NOI. So, but that's a market that a lot of people are afraid of, and that's a deal that's worked out very, very well for us. So there aren't any particular asset types or markets that we're afraid of. What we're more cautious of is ultimately who is our borrower on the other end of this transaction and what is the cash flow of any particular asset.
Deanna, this is Sheila Bertino. We have, unfortunately, time for only one more question, but I'm sure you've got a good one.
Oh, I've got lots of questions, but I guess if I had to limit myself to only one more question, Shane, if you could just tell us, in terms of lessons learned, advice for any individual who is trying to do this right now? I know that you had mentioned briefly about, you know, the challenges of raising capital, but if you had to pick 3 things that you would say were lessons learned, what would they be?
Sure. I'm going to give you just a real-life example. I bought a loan in Adrian, Michigan. The guy owes 2.5. We paid $759 for the loan. It's a commercial retail strip. When we underwrote 4 different borrowers. When we contacted the borrowers said, we don't own that property anymore. And that was a shock to us. 2 years ago, the borrowers sold the LLC, unbeknownst to the lender, which was a very large bank. They had no idea that this loan had been that this LLC had been sold to a guy out of San Diego. There was no way in any of our underwriting we could have ever known that LLC was sold. Now, it shouldn't have happened, and in the loan documents, it was against the loan documents for them to do a transfer like that. But that's one of the lessons for us that's been learned is, you underwrite these borrowers and you think you're going to be dealing with, a borrower, and it ends up being somebody totally different. And so there is risk when you're buying these loans. That's a particular loan that we're having to foreclose on. So one of the big lessons learned for us is knowing that there's a lot of unknowns. You can do a tremendous amount of underwriting. You can look at every file, and you will uncover things about that loan and about that property and about the borrower that just not even the bank knew. And so you have to price that risk into your overall evaluation and bid price.
Well, I know that there's probably a lot more questions that people have. And Shane, if you can advance to the next slide, that's where we have the email addresses for both Shane and Deanna. So if you have questions for them, they've agreed to let you send them directly to them at their work emails. And I want to thank you both for really a terrific presentation and for giving us a lot more insight into what it's going to take for liquidity to return to the real estate capital markets. For people who would like to hear this presentation again, it's going to be available by close of business today. And actually, all of the past programs for the Solution Series programs are available on the NAIOP corporate website. And I should mention, too, that we do have an archive of a past program that was given by Tom Galley and Al Bodette, which deals specifically with the FDIC structured loan program. So if you want more information about that, be sure to check out that particular archive. You just go to the front page of the NAIOP website, NAIOP.org, and click on the large button that says Solution Series. In March, we have 3 Solution Series programs, so we'll be quite busy March 3rd, March 17th, and March 31st. And you'll get, as always, an email from NAIOP Corporate with details about the topics and presenters. Now, remember, if you have topics that you'd like to suggest, please feel free to drop us an email or put it in your comments on the session evaluation survey that you'll receive directly after this program. Thanks again to our presenters, and thanks to you all for attending our session today. Goodbye for now, and we will see you at the next Solution Series program.